Okay, well, welcome everybody. This is going to be our installment of liquidity and liquidity voids. This is a little bit more of an advanced concept, but everybody that wants to listen in can go ahead and listen in as they may. The first thing that I'm going to basically explain to you guys, and this is also going to include breaker blocks. For everybody that doesn't know what those are, I'm going to explain them in a little bit. So the first thing that I'm going to explain is how many of you guys know what liquidity actually is? And why, if you want to pop in a point here and there, you can go ahead. So who here actually knows what liquidity is? And you guys can either speak or type it out. I have the chat box open so you guys can go ahead and participate. Equal highs, equal lows, okay. This ties into our previous class of bank logic, right? Because at the end of the day, the algorithm moves price, but banks will abuse that algorithm, and sometimes they make mistakes. Equal highs, equal lows, where the money is at. That's true. Cash, right? So if we look up the actual definition of liquidity, and let's go to Google for that. It's very simple. Let's say we look up liquidity definition, right? And I don't know why okay. Liquidity definition, right? Market liquidity. In business, economics, or investment, market liquidity is a market's feature whereby an individual can purchase said asset, whatever. A better definition is liquid assets or cash, right? Liquid assets or cash, the volume that you have available to you. So essentially, let me give it to you guys in a bit of a simpler term, something that you guys may understand. So let's say you guys have a savings account, right? Let's say you guys have an account, and say that account has $10,000 in it, right? 10K in it. Now you have these $10,000 to spend, but let's say you have a threshold of about $2,000 that you cannot go under, right? And that threshold of $2,000 is what you cannot go under. So what is your liquidity in this case? You cannot touch these $2,000 because they're, let's say, your savings. What is your total liquidity here?
8,000.
8,000. Your total liquidity is 8,000, right? That is what you can use. That is the total number of that is the total number that you can use, right? The banks work the exact same way, right? They cannot go under this little zone, which is something known as standing liquidity. And I've said this multiple times, and I'll say it again. Standing liquidity is something that you're going to have to understand, right? And this standing liquidity is something that banks cannot go under. This looks more like 200 million, right? In a bank's perspective, and this looks more like 100 million, right? But for simpler terms, let's keep it in the thousands, right? So now let's say that you as a bank, right, see that there is money to grab here and there. You're going to obviously move price in the direction of that liquidity to be grabbed. Now, I'll explain what I mean in a second. So as you guys remember, right, banks abuse the market algorithm in a certain way for them to get as much money as they possibly can and break even in as how many drawdown entries that they possibly can, right? So let's say the market makes its way up here, right? Like we said last class. Market makes its way up here. Again, like we discovered in bank logic, right? There's going to be entries right here, and right here, all for buys, right? Now the market staggers a little bit, makes distribution, right? Sign of weakness, up thrust after distribution, last point of supply, right? And now it starts falling all the way down, right? It starts falling. Now, when we see this distribution, we see that there is going to be a big push in price that the market actually never liquidated, right? All of this right here was never touched by the banks. Now, imagine if this was 2 or 3 candles, just straight boom, 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 all the way up. No retraces, no nothing, just straight 3 candles up. How many times have we seen that? We've seen that many, many times, where the market just straight up booms, like up, like in 1 or 2 candles, right? And what ends up happening almost every single time that happens? What ends up happening? You guys can comment. What ends up happening?
It retraces back.
It comes back, it retraces back, yeah, okay. It retraces back, but where does it retrace back to? Does it retrace back 50%? Does it retrace back 79%? Does it retrace back 38.2%? Does it retrace back 1%, like 100%? 50%, okay? 50%. I see some 50s. What about everybody else? What do you guys think? 38%, okay. 72 or 88 sometimes. Okay, I like seeing the 88. I hadn't seen that before. Good answer, Jalicia. 62 or 50, okay. 50 to 70, 62 to 50, okay, 50%. Okay, these are all great answers. And depending on your strategy, you will find different things. And there's a couple things that you will have to look for. If you guys have studied under ICT or, study as concepts, you guys would look for a 79%, right? A lot of people who study more Wyckoff theory, what they're going to look for is they're going to look for a 50% fill, right? And it really it doesn't depend on what strategy you're looking for, it doesn't depend on your strategy, what you look for. There's going to be a couple things that you want to look for. And the first things that you're going to want to look for is in that inefficiency, you're going to have to use something known as a multiple time frame confluence, right? Who knows what that is? Who knows what multiple time frame confluence is? TDA, I'm not sure what that is. Yeah, top down. It's also known as top down. Checking for the same thing on different time frames. Yep, exactly, right? It's very simple. It's simply looking for similar things on different time frames. Now, if there is a so what is this fair value gap? So this is known as a couple things, right? This is known as a couple things. These market inefficiencies are known as inefficiencies, right? They're known as inefficiencies. They're known as FVGs. You'll hear some people say FVGs, or liquidity voids. LQD is just a liquidity void, right? Now, these are all essentially the same thing. Essentially, they're around the same thing, right? An inefficiency is simply where banks move price way too fast that they can't get enough entries, right? A fair value gap is simply a gap where there is value, that there is liquidity that needs to be filled, right? And a liquidity void is essentially saying, hey, there is a ton of liquidity here, come grab me, right? That's essentially what they are. They're the same exact thing, but they're also imbalance. Imbalance is the same thing as well. Imbalance they have different names, copyright, but they're essentially the same thing. Now, let's go to the next slide and let me show you something on a multiple time frame. So let's say on a time frame there is going to be a 3 giant candles, right? There's 1 candle, there's 2 candles, and there's 3 candles, right? Now there's 3 candles, right? This is considered a fair value gap, because at this point in time, right? At this point in time, you've seen that essentially this liquidity was never mitigated, right? And again, if you guys remember what mitigation is essentially, numbing down losses for banks, right? Because a lot of them, and you guys can go ahead and watch our bank logic video for the full explanation of that. But again, continuing on liquidity, essentially all of this liquidity here is just sitting, right? It's just sitting there. Now, when all of this is sitting, you want to go, usually you'll see this on the 4-hour, the 8-hour, the 12-hour. You'll see them here, right? And not every single massive candle that you see is going to be a fair value gap. There usually has to be a large area of liquidity that hasn't been tapped on your left or right? Usually. So when you see these on these higher time frames, you're going to zoom in into a lower time frame and see what's up. Now, usually, if you see something like this on your lower time frames, say, and these are time frames that I have gotten from other people. These are awesome traders that have taught me these. The 2-hour, the 3-hour, you can also use the 1 hour, but sometimes using the 30-minute helps a lot. The 10-minute as well helps a lot. These time frames are, so these two up here are where you're going to see different patterns. And if you guys have joined our Discord, which is completely free, by the way, you guys can look at our patterns: the rally-based rally pattern, drop-based drop pattern, rally-based drops, drop-based rallies. All of these are very simple, right? And now these liquidities, now this liquidity is going to have certain stops, right, in certain places where banks have taken some of their profit and have set limits, right? And you're going to see exactly where those places are in a second. So whenever you guys see these, how you trade fair value gaps, there's a couple ways, right? Essentially, you're going to go down until these lower time frames, and you're going to check, hey, on these lower time frames, do I see zones where you can kind of consider a bank order? Oh, whoops. I really need to get a drawing tablet. Hold on. So now in this diagram, where do you guys think that banks are going to set their orders? In this diagram, where do you guys think the banks have set their orders? That last candle before the push up, by the small candles, the 3 candles. Okay, perfect. You're completely right. Now, when you break it down like this, it's very easy to see. But again, just like in live fire training, it's very difficult to see it out in the field, right? You have to train your eyes to see this. Now, for me and Wyatt or Sean, it's going to be a lot easier for us to see this. But for a lot of new people, it might be a little bit more difficult. So usually, you can go by a couple criteria. It's usually a pause in price, right? There's usually a pause in price. So in these 4-hour, 8-hour, 12-hour, you usually are accustomed to seeing a lot of distribution, accumulation, redistribution, reaccumulation type thing, right? All Wyckoff schematics. Now, when you see these, that's completely fine, but you're looking on very high time frames, meaning that pauses in price are not accounted for. If you look on the 2-hour, if you look on the 30-minute, if you look on the 10-minute, you're going to see every single break in price or every single, slight gap in price. And those smaller time frames, like I explained in the bank logic video, price is fractal, right? Meaning that whatever the 10-minute shows, the 30-minute is going to show eventually. What the 2-hour shows, the 3-hour is going to show eventually. What the 2-hour shows, the 12-hour is going to show eventually, right? So essentially here, you have a zone, right? You have a zone. Here, let me actually put that in different color. I don't know if you can. Yes, you can. So this essentially becomes a different zone, right? And since that becomes a different zone, what are we looking for here? And this, to a lot of people that have looked through the Discord would know that this is something called an RB R pattern, right? Or rally-based rally pattern, right? Because you have a slight rally, you have a base, and you have a rally, right? And so in proper notation for markups, this is how you would note a rally-based rally, right? An arrow up, an arrow side, an arrow up. The arrow side is essentially the zone. Since you don't want your chart to look too messy, you just kind of draw an arrow to the side, denoting that this right here is a specified zone of return. Now, what is a zone of return? Essentially, what this is this price when all of this liquidity is up here. Most of the time, price will return to either these zones like this, right? Or it will go straight back to the base, which a lot of times ends up being the 886 or the 79, right? Fib level. So let me explain this, right? Now price is going to come up here, and then it's going to create an order block, Well, no, essentially no. I'll get into that later, actually. No, it doesn't. So this is going to create a retracement, right? This is going to create a retracement. Now this retracement is going to go all the way down here. Now, as we discussed earlier, this is a zone of return. What does this essentially mean? This means that you can set your limits here, forget about it, and not have to come back to your phone until you're in profit. Now, how does this happen? This is very simple. You know that price is going to return here and either blast through to the 79%, which is down here, right? The 79 or the 80, right? Or the 1 kill zone, right? Whatever strategy you use. Or it's going to go back and say you set a horizontal line right here and your arrow is right around here, right? Your arrow is right around here. You know that price is either going to return right here or it's going to go down here, right? Because you have all of this liquidity. And banks can survive with a 50% mitigation of loss, right? So say they have $600 million worth of lot sizes down here, right? In cells. They mitigate 50% of their losses and they add more buys, right? So now all these 600,000 that they just lost, they put another 600,000 right here in buy limits and now they buy because they don't want to push price all the way down here. They're too impatient, or maybe they need standing liquidity, whatever the case may be. We don't meddle in their affairs. All that we know is that we have a rally-based rally pattern here and that we have the 79 OTE, 88 kill zone, and the 1 kill zone down here, right? So what do we look for? Down here, you would look for order blocks. Down here, you would look for order blocks. Up here, you're going to look for these patterns, right? So price is going to return here. And a lot of times what ends up happening is this. And this is why limits are so important. Okay, this is why limits are so important. A lot of times price will do this. A lot of times price will do that. And I have been trading for a long time and will tell you that a lot of times your limit will be wicked, get 2 pips in drawdown, and then skyrocket. Okay, and a lot of people may ask, well, isn't this a new fair value gap? No, because you just mitigated a fair value gap, right? You just mitigated losses. You just mitigated liquidity. So obviously this isn't liquidity, right? This is just the reaction off of that liquidity, right? That's all it is. So now what you're going to be looking for here is essentially you look to set your limit at around wherever the opening of the body is. Some people like to put their limit at, the top of the wick. That's fine too. You'll have more drawdown, but you can, right? A lot of people prefer having a wider stop loss and making sure that their limit is triggered rather than, a lot of times, like it's been happening to Zay recently in gold, in oil, he's been missing his limits by that much. Literally by that much. It doesn't hit his limit by like a pip, or by spread. It doesn't hit, right? So if you want to put your limit at the middle of the wick or at the top of the wick, that's completely fine. You can. But at the end of the day, what you're going to be doing is you're going to be hitting this zone where all their buy limits are at, right? So you know that their buy limits are going to get triggered down here. And since you want to trade with the banks, this is essentially what you're going to go in. This is exactly where you're going to go in. So how can you actually apply this tonight in your trading, right? How can you actually apply this? Well, how you would apply this is you would see if there are any fair value gaps in the trades that you are looking for. And then after that, you would look if there are any rally-based rally patterns, drop-based drop patterns, which is essentially this, just flip it over, right? Which it would be like a drop, a base, and a drop, right? Just flip it over. And then there are also others like a drop-based rally and a rally-based drop, which are thoroughly explained in the Discord. And if you are not in the Discord, go to the broadcast channel and you will find our link tree, or just ask for the link tree in the discussion chat. And you will be supplied the Discord, which is completely free. It's an institutional trading textbook that will take you from the basics to a little bit more intermediate level trading. So now, when we look at these patterns, right, and we look at this liquidity, we see that the banks, think about it like a bank, right? Say you are the executive trader of a bank, And obviously, because of the rules of supply and demand, right, for price to be buying, people have to be selling, right? So since people have to be buying and selling, and retail doesn't have enough money to counter your trades, you're obviously going to have trades in drawdown for you to move price upward, right? It seems a little bit counterintuitive since all you want to do is win, but it works for the banks, right? Because in this case, they have a ton of buy limits equaling all of their losses down here, right? Now, think of it like a bank. Say you let price drop a little bit and you let it drop, right? And a lot of people are going to start selling here. But what do you know? You know that your buy limits are here. You're going to make price touch your buy limit and then skyrocket, right? The next trade, the next candle is going to look something like that, right? And you're going to be in profit. You have just mitigated. Hold on, let me. You have just mitigated all of these losses, right? Say you have 600,000 in sells down here. You have just mitigated all of these losses because in these buy limits, you now have, say, 800 buys. Whoops. Right? You have now mitigated your losses. Since you have now mitigated your losses, you are now no longer in drawdown and price is going to skyrocket. Right? Price is going to skyrocket. And obviously, you and every other bank out there is going to be profiting off of this trade. Why? Because they know exactly where price has set their limits, right? Now, why has price paused here? Price pauses here essentially because banks are going to do one of the following things. They don't have indefinite liquidity, meaning they don't have an infinite amount of money that they can just pull out. Again, they're dealing in the millions, billions of dollars, right? So what are they going to be doing? They need to take some profit. So here they're going to take some profit, and that's what causes a pause in the market. Because essentially they're taking a little bit of money out and putting buy limits there again to again recuperate the amount of money, but they need that money now, so they take it, right? Maybe some other orders and other pairs are in drawdown and they need that money to hold their equity. That's fine. But this pause in price is what lets us know where to set our limit. So how would you use this? You would look for these patterns on these time frames like I specified, and you would essentially set your buy limit either at the opening of these bodies, or you would put them, if you want to be a little bit more risky, put them on the wick, right? So here's going to be your buy limit, and here's going to be your stop loss, right? Below the candles, below the wicks of the candles. Now, why would you put your stop loss below the wicks and the candles? You essentially want to put it there because if it pushes below that, you know for a fact this is going for the liquidity at the bottom. Now, whenever these trades happen, this is minimal risk. And this is what me, Wyatt, Sean, Matt, and all of us love. We love low drawdown because that way we can pop a little bit higher lot sizes. We can be a little bit more lenient. We can say, hey, if my account can hold, a 0.10 normally, I can pop a 0.15 now because this is only, say, a 13 pip stop. And this is say an 130 pip take profit, right? So this is say an 130 pip take profit. So it becomes a very, very good risk to reward because you're risking 13 pips for 130. And if this stop loss gets hit, you lost 13 pips. That's literally nothing. That's like $15, right? On a 0.15. And then you know that if liquidity is going to return to the base of the fair value gap, which sometimes it does, right? Sometimes it returns to the base of the fair value gap. Then you can stock up on buys up here, down here, and this will usually have an order block, right? This will usually have an order block. So this will usually have like a downward candle, say down here, right? And this downward candle led into this upward candle, right? So now you're going to be targeting the open of the order block, and you're going to set your buy limit right here. And this is a completely different topic, but I'm sure a lot of you guys know how to use order blocks to your advantage. So essentially, right, that these gaps in liquidity are going to be targeted by banks. All that you're doing is you're spotting a value gap or a liquidity void on the 4-hour, 8-hour, 12-hour, right, on the higher time frames, and then you're dropping to the lower time frames and you're actually studying, or you're looking for these details, and you're looking for these breaks in price, or or if these breaks in price aren't there at all, which sometimes happens, then you let price retrace all the way down to its order block. You don't fight it, right? You do not force it to come all the way down. So let me understand if price will go back to the order block or the secondary kill zone. Hold on. I heard someone say that order blocks are the true support and resistance. Kind of, that makes sense. Banks don't want them being broken until liquidity is collected. I'll explain that in a second. So fair value gap is just really big momentum candles. So not always, right? Not always. You cannot have a fair value gap that has already been mitigated on the right. And this is actually a theory in banks, right? That's essentially the left-right rule, right? So essentially what that is the left-right rule is essentially this. If on the left, right, price creates a strong surge in value, right? If price on the left creates a strong surge in value, and on the right, there is essentially a big void, this is a fair value gap. But price cannot create, say there is a void on the left, right? And now there is, say there's candles on the left, right? And now price does this. This right here is no longer standing liquidity. This here is no longer standing liquidity. Why? Because banks have already mitigated their losses, right? Banks have already mitigated their losses and they're going to continue up. A lot of people get caught there because they try to look for order blocks, quote unquote, order blocks, the wrong way, right? You should only be looking for order blocks essentially on the way where price is going currently, right? So say on the left, right, there are candles coming, say, down or whatever the case may be, right? This doesn't matter. Now there is a big surge in price, right? This was a fair value gap here, now was mitigated by this drop, right? And now continues on up. This no longer is standing liquidity. This has already been mitigated, okay? Wyatt just sent an example. Let me go check this out. Let me share the screen with you guys. Okay. So this is a perfect example of something that you guys would be looking at down to the pip, right? A lot of you guys have been asking, hey, how can I get, low drawdown entries? Talk to Wyatt. He's very, very good at these. And I'll be talking about volume in our next class, actually. So here we have a lower time frame rally-based rally. On the 30-minute or on the hour, this would be flat, right? And essentially what you guys see here is, right, the correcting notation. You see the rally, the base in the rally, right? And you see that price surged here, stuttered, right? A price break, and then surged back up again. Now, what do we see here? Essentially, we see that the rally-based rally has now been retested, right? This drop. A lot of people are gonna, be like, oh, well, where do I set my limit? You're gonna set your limit at the opening of the body, or sorry, like the top of the bodies, which would be right here. Now, some people's brokers have higher spreads than others. So what I would do is I would set it a little bit higher than the opening of the body. I would set it right here. That way your spread is obviously going to hit, right? Boom. And now what happens? You are in almost no drawdown and you get a giant push upward. Well, it's on the 15 minutes, so it looks giant, but it gets a pretty big push up. And when you get that that liquidity and that imbalance, so this is also an imbalance because you see how this big move in price actually was never mitigated. This right here was mitigated, and this right here was mitigated, but this right here was never mitigated until price comes back down and actually mitigates it or fills the imbalance, right? And it also so happens, right, miraculously to hit a rally-based rally. Not so miraculously, but obviously now we see how liquidity works with the banks and where we actually get the patterns of rally-based rally, drop-based drop, rally-based drop, drop-based rally, right? That's where we get all of these from. But a lot of people don't understand that. They don't understand that these big candles that on the left have been filled. If we would look on the left, right, there's actual liquidity there. Now, it comes back down, and on the right, the left creates the imbalance, the right mitigates it, right? The left-right rule. If on the left it's mitigated, we don't care, right? On the right, if there is nothing filling these giant candles, that becomes a fair value gap or an imbalance, right? So if we would use a replay tool, we would see it right here, and we would essentially set our limits right here, right? Why wouldn't we set our limits here? If somebody can answer that, why wouldn't we set our limits here? Right up here. Why wouldn't we set our limits up there? Is that a breaker as well into an FVG? No, it's not. I'll explain breakers in a second. It's not cleared yet. Okay. There isn't a strong push after the liquidity was collected. Well, essentially, yes, Angel, you're correct. Liquidity was already collected, right? So there was no downward break in price. There was no break here. All that happened was liquidity was mitigated, right? Boom, boom, and then it continued on upward. There was no break in price. Here, there's an obvious break in price, right? Because there was a successive amount of candles going in the opposite direction, right? So if we were to connect these two, they would become a seamless, candle upward. But since there was a break in price right here, this is where we would set our limit. And a lot of people fail to understand that. But those of you guys that have understood order blocks and that have understood liquidity will know how this works. And I think I've explained it pretty well in these past few minutes. What do you guys think? Do you guys have any questions for me? Could I answer some of you guys' questions? Oh, this would also be a good example of showing your fib, right? You can also show your fib, and this would be around your 79 optimal trade entry. Or if you would fib it from here, this would be around your 886 kill zone, right? And essentially, when you're looking at lower time frames, you can do that, and you can pretty much fill all your Confluence checklist. So do you guys have any questions about how this liquidity works, about how fair value gaps actually work?
So when you draw your liquidity zone, do you want it to retrace like a little bit? If that makes sense?
Okay, so I think I understand what you mean. So essentially what you're saying is, like, do you want price to, do you want price to have like that little break in price, you want it to be a retracement?
Exactly, because I thought the base would usually be more horizontal, but if that's fine,
Right,
then...
so it is, right? In this case, it is. But what happens, it's on the 15-minute, keep in mind. Say if you're looking at a 30-minute, that would make it flat. Right, it's really just a time frame that you look at. Let's see if we can find one. Oh, actually, gold is a very good one. Gold is a very good one, and I'll explain why in just a second. Let's look at the 2 hour. So right here, what do you guys see?
Is it accumulating?
No, accumulation was on the daily all the way down here. But let's say we look from here to here. What do we see?
Drop, base, drop. Big
Yeah.
facts.
Yeah, you do see a drop base drop. But what do you see right here?
A void.
A void, right? You see a void. On the 2 hour, it shows a void, right? It shows a fair value gap. That fair value gap essentially says, hey, there is a lot of liquidity sitting up here that we have not touched. And we need to touch it, right? Because remember that the theory of equilibrium will always stand. No matter what strategy you use, the market will always find its equilibrium. What does equilibrium mean? Meaning that if there is liquidity that has not been touched up here, it must be touched, right? The gap is right here, Angel. So the gap is all of these red candles that just straight up keep going, okay? So from here to here, it's essentially our gap. Now our gap was mitigated right up here, up here, and now up to where price is right now. So we're more than 50% mitigated with this gap. Now, since we're more than 50% mitigated, we're going to essentially see bullish price action all the way up to 2017, 2035. Around 2035 is where it should fill. There's also another gap right here that could or could not be filled. It doesn't really matter because our target is 2014, right? It could also fill up to 2053, right? Now, so are liquidity gaps not as effective on lower timeframes? You will see liquidity gaps everywhere, right? You will see liquidity gaps effective on lower timeframes as well. This shows on lower timeframes as well. If you look at the 10-minute, if you look at the 15-minute, if you look at the 30-minute, it will essentially show this. It will show it the same way, just with a couple more breaks in price. Now, if we look at, say, the 30-minute, you will see that there's no bullish position for us, right? This isn't really a clean break in price, so this is not considered a drop-based drop, right? This here was considered a drop-based drop, and what happened? Price wicked it, came down, right? It came down. Now you could have taken profit there. That's up to your discretion, right? Now in this position, we may see a base be formed here, and then a continuation, and then a drop again, and then continuation back up, right? That's something that we could see. Now, do you think gold will keep going up? Yeah, I definitely do. So now we see this fair value gap, right? And when we see this, essentially what we're going to do, you see how on the 1 hour it's still dropping? You see on the 1 hour, this drop-based drop also matched up. Look at this. Drop, correct denotation, right? Right? Drop, base drop. And now what happened? Retraced, came back up, dropped again, right? That was a couple of pips for you. Perfect. Now, here's another thing. Since we have this fair value gap targeting almost 2014, you could go up to 2028, 2030, or 2025, right? When you see all of this stuff, you essentially say, hey, gold is most likely going to go up into this position. So what did I do? As soon as it, could say, quote unquote, jumped, right, from here to up here, I decided to place an entry. So my entry was closer to up here. But my entry ended up being around this area. So right now I'm very well in profit, right? But is it going to continue? Yeah. A lot of people might get shaken out of their entries. A lot of people may want to close their entries or a lot of people may not want to enter. Personally, I think it wouldn't be a horrible entry. You would have to keep a tight stop loss, probably 1976, right? 1979. That would usually be your break. Right, so right here, if it breaks below, you don't want to be cut in that gap, and you essentially kind of scale out, and you say, nope, I don't want to be in there, so your stop loss would be around 1978-ish, right? 1979. From here, you would essentially be looking for a fill of this fair value gap all the way up to 2016, 2014, possibly a little bit higher, up to 2023, 2024, 2025. Right, that's essentially where you would look at because of this fair value gap that was created here, right? So the bank obviously isn't going to mitigate 50% because we already passed 50%. So now we're going to target 79, 88%, right? Very, very, very few times will banks stop at the 61.8. Very, very few times. A lot of retail traders, a lot of these gurus will tell you 61.8, 61.8, 61.8. Essentially, a lot of the times the 61.8 will not be respected. Do I expect more bullish price action on gold? Yes, I do. I think this fair value gap will be mitigated. We might see a drop back to the 1982 level, and then we may continue seeing. We may see continuation upward. Now, as you can see, and this will go to our second section, which is Wyckoff. This looks like lower time frame distribution, right? This looks like obvious lower time frame distribution. And gold is such a good example of these things, but it will confuse a lot of people because they don't study these things in depth, right? So if you guys don't remember the schematics, let me look it up for you. These are very, very easy to find. We have shown these guys to you multiple times. We have sent this link out multiple times. If you guys need the link, here is the link. Wyatt sent this a long time ago. I suggest you guys give it a read. But what I'm going to, it is a very lengthy read. So I will make a video on this later, but we're going to look at our distribution schematic here, and let's see which one it matches up to more. Seems to match up more to our distribution 1. Right, yeah, it looks a little bit more toward distribution 1. Either way, it's distribution, right? So what we see is right here, we end up seeing our buying climax, right? We start seeing our buying climax, our up thrust after distribution, right? And then we end up seeing our, because this buying climax, automatic rally, up thrust after distribution. And now we end up seeing our last point of supply. Now our last point of supply in the lower time frames essentially hit this little position right here that we have. You might have missed your entry because of the fact that you might have placed your order block right at the body of that wick. Would have been okay. I mean, you would have missed it, but let's say if we look on a little bit higher time frames, if you matched it up to 50%, it actually filled 50% of this candle, which a lot of times does happen. So that's another note that you guys can take. So this up thrust into this drop was essentially given by this distribution and was given by this a little bit higher time frame order block. So we see this classic distribution. However, distribution kind of showed off, and it showed off its massive power by essentially dropping straight down, right? So again, explaining this fair value gap. This fair value gap is what we're looking to fill. Now, do we see accumulation here? Maybe on lower time frames. I wouldn't exactly call that distribution. Actually, yeah, you do. Yeah, you do. You see reaccumulation right here. Reaccumulation, again, is simply, so when you're in an uptrend or in a downtrend, those pivot points are caused by accumulation or distribution. Let's say you're coming out of distribution. A lot of times you will see redistribution. Or if you're coming out of accumulation, a lot of times you will see reaccumulation. And that simply means that price has acquired enough liquidity to make another giant push up, right? And right here, essentially what we saw is another jump, right? We saw the secondary test, spring, and now we see a last point of supply and another jump. So now here, what can we see? We could possibly see another point of redistribution. Right, we might drop a little bit and then come back up, drop a little bit, rise up again, consolidation, right? And then we might have that reaccumulation schematic to shoot back up to 2014. So whenever you guys are looking at these schematics in Wyckoff, essentially what you're going to be looking for is you're going to be looking for places where price consolidates. Because wherever price consolidates is usually wherever these schematics end up showing their face. Right, and I used to be the trader when I was first learning this a couple, years ago when I first started. So I didn't even know that I was trading Wyckoff. I just knew that price kind of moved in that way. I knew it by a different name back then. So whenever I would always try to catch the up thrust after distribution or the UTAD, or I would always try to catch the spring, right, and get that super sniper entry. And until I realized that wasn't really the way to go, because a lot of times you end up missing a lot of the move, or you end up putting your account in a lot of unnecessary drawdown. So essentially what you want to do is you want to wait for this last push after distribution, which if we go back to these schematics, essentially you would look for the last point of support. You would look at these, and let me go over these little abbreviations first. So PS is preliminary support, SC is selling climax, AR is automatic rally, ST is secondary test, and springs will be these drops under the trading range, right? And now the test will be after the spring, and it will usually be kind of a retest of this zone of the trading range, and then it will continue up into this last point of support. Now, this last point of support is essentially where you want to catch your entry, right? Whenever you see this retraced in Wyckoff, you want to use whatever strategy you want and get this last point of supply. and then from there you're going to see this BU or back up, right? Essentially, that's also known as jumping the creek, right? By some people, and that's essentially when, say, this trading range is a creek, right? This trading range is a creek. Price just jumped it, right? It just went boom out of it. This sign of strength, right? The sign of strength kind of shows you, hey, price is definitely going to continue on upward. Might as well get an entry now, right? And a lot of people know this as quote unquote bullish flag, right? But a lot of times that bullish flag ends up getting broken for a retest of this last point of support, and then continues up, right? So you really want to wait until phase C, phase D, or phase E to catch your entries. A lot of times phase C is unsafe, so you want to stay until the LPS or the jumping of the creek and then getting in, right? That's just kind of a bit of a safer entry. Now, when you're trading stocks, it's almost the exact same thing. For me, it's a little bit easier to catch the spring and the test on stocks than it is in foreign exchange, because foreign exchange moves so quickly, right? Since these currency pairs move so quickly, I would rather just get in on the last point of supply and then re-enter on the creek jump, and have 2 entries riding in profit all the way up. Now, because of the price cycle, right, that accumulation is the bottom, and then it's going to shoot up, right, and then it's going to reaccumulate and then continue shooting up until it actually comes up into distribution, which is the other schematic that we looked at, right? So essentially, try to connect these two. Let me give you guys a little bit of a whiteboard example. So essentially, you want to start connecting these two in something called a market cycle, right? And this market cycle, I'm just going to type it up here. So this market cycle, right, ends up being the thing that essentially makes price move up and down, right? So say you have distribution. Say you have distribution, right, and then it comes all the way down. Now you have distribution coming all the way down, and from there, what you're going to end up seeing is that accumulation ends up happening, and I'll explain to you why. Let me redraw this and make it a little bit smaller. So say you have distribution, and now you're on the way down. Now you have a little break in price, right? Say on higher time frames, it may look like a small break in price, but on lower time frames, it may look like distribution one more time. This is known as redistribution, right? Now, let me erase that and actually type that in, because that is kind of floating. Guys, make sure that you guys are muted, because it's slightly disruptive to the class whenever people aren't muted. Thank you. So this would be known as redistribution. And this redistribution is fairly simple to find. It's really just a break in price, where if you would zoom into lower time frames, you would see that this is essentially redistribution. Now this continues on down, and now we see a very familiar schematic. What is this? Accumulation, perfect. Right, and now this accumulation, essentially this market cycle, acts like a sine wave. If you guys, took higher math, you guys will understand what a sine wave is, right? The market simply moves like a wave. It moves catching its own liquidity. It moves back in its cycle. If banks don't have enough liquidity to keep up selling, they're going to go into accumulation, right? It's fairly easy logic. Now, let's go and let's continue the search, right? The search happens, keeps going. Now there's this fair value gap, creates a little distribution, comes back down, more accumulation, boom. And now comes back up here. We have these highs. And now, all of a sudden, wow, creates distribution and then falls back down. All of this is simply the market cycle. That's really all it is. It's like the water cycle, right? Price goes up, comes back down, goes through the earth, and comes back up, right? It's the exact same thing. only that this is price moving up and down. This is liquidity moving up and down.
1,120.
Holy hell. Okay. Accumulation, and we have this distribution right up here. Cool. Now we have this accumulation. Perfect. And this is essentially how the market cycle works, right? This is essentially how the market cycle functions, the market dynamic, right? Banks are essentially going to take price and they're going to fill their own liquidity. They're going to catch their own entries. They're going to basically catch themselves and abuse the market distribution algorithm so that they can make as much profit as they can, right? The market algorithm isn't something that's, rocket science. Essentially what it is the laws of supply and demand. Essentially what it is for there to be a buyer, there needs to be a seller, right? And wherever there is more heavy liquidity, price is going to go to. So if there are more buyers, obviously price is going to go up. If there are more sellers, obviously price is going to go down. But obviously in both situations, there has to be buyers and sellers. If there are no buyers in a sell, price is going to plummet and crash, right? And I'll show you an example of this, of when retail faces institutional. And I'm going to unshare my screen. I'm going to unshare my screen really quickly, and I'm gonna find this. I'm gonna find this for you guys. I'm pretty sure Wyatt knows exactly what I'm looking for right now. I'm pretty sure he knows exactly what I'm looking for because we've looked at this before. Is this the pair? I believe it is. Yeah, here it is. This is actually a pretty good example of a fair value gap also. Let me show this to you guys really quickly. Let me take off all my indicators. Thank you very much. Now I'm going to share this with you guys again, but before I share it again, is Wyatt still here? I don't know if he is. No, he's not. So a lot of times people ask, hey, what happens when when banks take their levels and say, hey, we're going to take all of our orders out on buys in a sell. Okay, we're going to take out all of our orders back, and we are going to eventually say, hey, we're going to flatline the market, and we're going to see how retail reacts, and then from there we are going to take our own liquidity. And I want you guys to give you guys a guess. So we have right here our position, right? And we have our position. This was in September of 2014. Now, this right here is EuroChef, right? And Euro CHF is a very dynamic pair because of a couple of reasons. It's very slow, but the reason because of it is because it's a very, very powerful currency like the euro against a very, very weak currency like the Swiss franc, right? Now, when we see this, what do we see? What do we see? What's the first thing that we see here? What's the first thing that we see here?
Price is kind of flat.
Price is flat, right? Price is really flat. This is the importance of keeping your fundamental analysis online. It's not something that you should completely trade off of, but it's something that you should very well keep in mind. So the reason why price flatlined here is essentially because banks said, hey, at 1.86, we're putting a peg there, right? And we're saying price isn't going to move any lower than this. We don't want price to move any lower than this. So essentially, we're going to keep price right there, and it can only go up from here. That's what banks said. That's what major analysts said. That's what a lot of people said, right? Now, if you know that banks say, hey, we're not going to go below this level, to every single retail trader in the world, what are they going to do? What do you guys think all of our retail traders did?
Gonna
Buy.
buy.
They bought. What do you think they bought? What do you think 93% of traders were long on this pair? Why do you guys think that?
From past price.
Well, past price has pushed below that, right? But the banks did say, hey, we're not going to move past this. What they failed to see is they failed to see distribution on lower time frames. But we'll get to that in a second. 93% of people were short on this pair. Sorry, were long on this pair, my fault. They were long on this pair, meaning that they were buying this pair. Now, let's see what happens. Let's up the ticks a little bit. Now price is going up. Oh, I'm blue. We're blue, right? We're amazing. We're such good traders. We're blue. Okay, your first take profit is hit. Blah, 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 blah. We're going to stay around this keg. We're looking for more buy limits right here. More buy limits. We can only go up from here. Banks are only going to go up from here. We're institutional traders, right? We're institutional traders. We're amazing at this, right? We're amazing at this. We look, our buy limit got hit. Buyer VIP, right? Price is just sitting there. It's not doing anything. It's literally just sitting there, catching as much liquidity in its own little puddle that it possibly can. Price hasn't moved at all. It's saving up for something. It's like a coiled spring, right? Whenever you guys pressure a spring together, obviously there's going to be more force, right? Oh, what happened there? Guys, this was one candle. On January 15th, 2015. One candle. One singular candle. In about 30 minutes did this. Okay. Let's measure it. It was a total of about 2,382 pips. One candle. You know what was the worst part about this? Stop losses didn't get triggered. So people's accounts went into negative. Brokers went completely out of business because of this. Okay. A lot of the Forex market got knocked out completely by this move. This was an amassing of liquidity, a compressing of the spring. What happens? Compression, boom, distribution or expansion, right? You'll get to that topic later, contraction and expansion. But you also had this fair value gap and you filled it. So you filled it. And what ends up happening? Now you have a fair value gap right here, right? So obviously, what do? A lot of retail traders are going to keep selling, right? Oh, it's going to keep selling. But since you know that there's value up here that needs to be filled, you're obviously going to try to take as much liquidity as you can to the top, right? And you know that there's going to be no patterns here. So, because it's literally a straight line down. So what you're going to do is you're going to try to fill liquidity all the way to up here. 79, 88.6. Let's speed it up a little bit for time's sake. Here comes your entry. Oh, what is the schematic we see? Jumping of creek, entry. So your entry was right here. And your take profit would have been the top. Again, your entry gets tapped. And at that point, you're floating around 200, 300 pips in profit, so you would have been good. Again, we find this major zone, which now has become a demand zone. Again, your entry gets tapped. Now we see another gap. And there you go, another surge up. About 1,000 pips in profit now. Here comes your 1,000. Continues back up, fills the fair value gap. And your take profit got slapped, I believe. That it was missed by like a couple of pips. There it is. Your take profit got slapped. Now that was a take profit of about 1,280 pips. Now price is free to do whatever the hell it wants to because it has just filled its fair value gap. Now you see a little bit of distribution. You can expect more downside, more downside. Perfect, more downside, right? And that is essentially the example that I wanted to show you guys because this is a great example of showing how banks can control liquidity because of the sheer amount of money that they have, right? And the sheer amount of money is astounding. Don't try to compete with them. You're not going to, don't try to force your trades, right? And a mentor of your mentor, or Leslie, as we know him, friends know him, he always says, let's hunt, right? And what does let's hunt mean? Essentially, a hunter will not allow his, well, they won't force their prey to walk into the trap. Or they're gonna wait patiently for the prey to actually come to their trap and then jump on them, right? You're not going to try to force or yell at, a deer for it to stand still. It's going to get scared, right? You are essentially trying to hunt for your limits. You're going to hunt for price to return to wherever you would like it to be. You're going to hunt and allow price to come to you so that you can finally pull the trigger on your buy limit or on your market execution, however you would like to do it. And from there, you will allow price to show its cards. Oh, perfect. Look at that timing. Let the market show its hands. Exactly. Let the market, in poker terms, let them fold. You are going to be the one that is holding back, and you're going to allow price to come back to where your analysis showed. And if your analysis gets stopped up, hey, that's fine. Because of what I just showed you, your risk has gone from 45 pips, 35 pips, 60 pips, like I've seen some people in some undisclosed, unnamed multi-level marketing pyramid scheme. I have seen, right, 65 pips stop loss for a 20 pip take profit. That's ridiculous. That's stupid. That's not trading, that's gambling. That's also forcing a trade, right? That is not something that you want to be doing. What you want to be doing is you want to be having 17 pip stops, 22 pip stops, 30 pip stops for 100, 200 pip take profits. That's what you want to be doing, right? You want to be doing that because at that point, you can pop higher lot sizes. When you have a 2 to 3 pip, when you have a 4 to 5 pip stop loss, you can pop a high lot size and still be well leveraged, right? You can pop a very high lot size because, a 0.10 with a 4 pip stop loss, that's $4. Right, that's $4. Now let's say you want to risk only 6% of your account on a $100 account, and you pop a 0.10 with a 6 pip stop loss. You are nearly doubling. You are doubling your account if your 100 pip take profit 1 gets hit. You're doubling it, and it's possible. You can do it, but you have to make sure that your analysis is spot on. Right, because you can't take $6 loss after $6 loss after $6 loss because because your stop loss was too small, or because you try to force a trade, or because you pulled the trigger early, or because you're over leveraged and you forgot to place your stop loss. These rookie mistakes won't fly. Okay, they're not going to fly. There is no excuse for mistakes. Now I understand, some people are tired, some people have other stuff to do. I understand that, but if you are not in the mindset to trade, don't trade. Just observe the market, learn, take notes. And come back the next week and try to do it. The market is going to be here every single week. I've been doing this for almost 3 years. It's going to be here. Right? They're going to be here. They're not going to go anywhere. Exactly. Like Zay just said, right? You know, buy USD CAD and they have like these giant numbers on. That's for hedge funds, not for us. Because unless you guys have thousands of dollars in the bank, I really don't want you guys going into that much drawdown. Because your accounts aren't going to be that massive. Right? That's how you get your account blown. Exactly, precisely. So I hope this has helped you guys a little bit. I hope I'm probably going to do a class on patterns because this class is going on for about an hour. So I'm going to go ahead and stop there. Thank you guys. Thank you guys for coming. Now, I'm going to take some questions here, and this is the time that you guys can go ahead and speak and ask your questions. I'm going to take only a couple questions because it is slightly late and I have to go mark up my own charts. But can I look at USD CAD right here? Yeah, I'm going to stop the recording. Thank you guys so much for watching. If you guys are on the YouTube or find us on the YouTube channel, make sure to please check our Telegram group out. We are completely free, and we're here to help you guys out and try to make sure that you guys get the education that you guys need without having to pay ridiculous fees. So please make sure you guys check us out. And if you guys have a little bit of time, check out our Instagram and other social media. Thank you guys so much for coming, and I'm going to stop the recording here, but I'm going to continue with the class. Thank you guys.